In this video, I'm going to show you how I use the Commitment of Trades report to get an edge in the market and the calculations I do to make it even more valuable. Do not ignore this free report given to you. It is a gift for trading. Using the Commitment of Trades report is a vital but still only a small piece of my strategy. My full strategy is available on my website. The link is in the description. It is a transparent look at my unique blend of tools for analysing the market, and it is available now for a discounted rate of $95. This price will be going up as I go through and add video explainers to each part. So if you don't mind reading, you can save yourself some money. So to find the Commitment of Trades report, you'll need to go on the CFTC website. This is cftc.gov. When you get there, you'll see Market Data and Economic Analysis. Click that. We'll go down to Commitment of Traders. These are the most recent reports. We've got 6th of February 2024. To find historical reports, we go on Historical Viewable. And then that is done by date. So let's just go back to where we were for the most recent report. And the information we need is on the short format. So let's have a look what it looks like when we open one of these up. Let's start with the Chicago Mercantile Exchange. That's where the majority of the foreign exchange is. We'll zoom in a little bit. Scroll all the way down, keep going. We've got all sorts of commodities here, cattle, cheese, lumber. Right, the first one we've come across is Canadian dollar. And you can see it's split up into market participants. That's non-commercial, commercial, and non-reportable positions. Non-commercial. These guys are the speculators. They're trying to make money from the trades that they're doing. They've got people like hedge funds, large individual traders, and then we've got the commercials. These are the majority hedgers, so they're just trying to hedge their currency risk. That would be people like banks, manufacturers, airlines. Example of this would be Toyota. They sell a lot in dollars, however their accounting is in Japanese yen. We're only really bothered about the non-commercials and commercials. You might hear me refer to these guys as the speculators, non-commercial, or the commercials as the hedgers. So speculators, hedgers. Right, now we're going to talk about collecting the data. Every weekend or Friday afternoon, after the report is released, I will put the numbers into this Google Sheets database, which is available on my Patreon if you want to take a look. It's got all the assets that I trade. You can see these down at the bottom, along with the recorded IG client sentiment, which is another part of the strategy share. And that works on a contrarian bias. But that's up to you to take a look at. Rather than doing it all yourself, you can just get sent the link, or I can add your email to this and you can view it as I update it. Right, so let's move on. Back to the euro positioning from the CoT report. I enter these on here so I can do further calculations. What you can see here is the blue. The blue is inputs and the grey are results of calculations. So I'll explain the calculations moving from left to right. We've got total positions. That's obvious. So we're just doing long plus short, getting total positions. And we get net positions, which is longs minus shorts. And then we have percent long. So that's the percentage of the longs over the total positions. You can see we're at 59% long here. And that's the calculations are the same for the commercial positions. And open interest is just added manually. And then we're going to look at the composite CoT and the CoT index. Composite CoT is, as you can see here, net specs minus net commercials. So we've got this net minus this net. It gives us that. And then finally for the CoT index, this is a little bit more complicated. It's a percent rank for the last 52 weeks. Percent rank is basically just percentile. So now I'm going to explain how to use these calculations and how to use the report to get an edge. There are a few things you need to know about the key market participants, speculators and hedgers in order to get any benefit from using the CoT report. Starting with speculators. Speculators are trend followers and their positioning is on the correct side of the market for the majority of the move, but they are wrong at the turn where the market reverses. So therefore, it is profitable to stick with the speculators during the ebbs and flows of the trend until an extreme is reached. Peaks and troughs in speculative positioning will likely align with the peaks and troughs in price. As you can see from this image, the Euro USD with speculative positioning shown underneath, a peak in speculative positioning pairs nicely with a peak in price. A trough in speculative positioning also pairs nicely with a trough in price. Hedgers are on the wrong side of the market for the majority of the move, but they are correct at the turn where extreme sentiment is reached. We only want to be aligned with these hedgers at market extremes, and that is where the CoT index comes in. CoT index tells you the market is an extreme when it reads either 0 or 1. A reading of 1 means the composite CoT is the highest it has been in 52 weeks. This is a bullish sentiment extreme, meaning speculators are extremely long and hedgers are extremely short. This means it is primed for a bearish reversal in favour of the hedgers. A reading of 0 means the composite CoT is the lowest it has been in 52 weeks. This is a bearish sentiment extreme. Speculators are extremely short and hedgers are extremely long. This means it is primed for a bullish reversal in favour of the hedgers. These extremes mean there is a higher probability of a reversal, but it by no means guarantees it. Do not blindly follow the CoT index, as we see the 0 and 1 readings quite often. These will always be present at market turns, but also show up at other times, so therefore ruining the reliability of the CoT index. To combat this, we need to take a deeper look at the data to give us a better understanding of the psychology of the participants. We do this by combining CoT index alongside percentage long to filter out these bogus signals. At significant market tops or bottoms, you will find that speculators and the hedgers will likely disagree the most. To use percentage long as a filter for the CoT index signals, we need to see a significant majority of the positions held by speculators and hedgers to be very one-sided. A perfect example of this working would go as follows. You see a CoT index of 1, meaning extreme bullish sentiment indicating a potential bearish reversal. To verify this signal, you'd want to see one or both hedgers and speculators at extremes in percentage long. More specifically, hedgers' positions could be around 10% long, extremely bearish. Speculators could be around 90% long, extremely bullish. In a situation as extreme as this, you can almost guarantee the commercials, hedgers, will force price down and speculators will capitulate. The reverse would be true for a move up in price.